what we talk about today. How do I make it in crypto in 2026?
Hold the right assets and do nothing. And don't rent conviction from people. Do your own work. And then you'll find your own conviction. And that's a really important thing. And don't look for a low price in terms of unit cost. And then find a echo chamber of narrative that comes around that. We've all done that in the past. Just openly look at the space and say, how much risk am I prepared to take? What is my goal here? Am I trying to compound wealth, or am I trying to get my starter pack of money to play the casino with? I get that speculative side, but you can do it in a smarter way and just have a time horizon that is realistic. And looking at it 3 months, 1 month, 9 months, 1 year still doesn't make sense. My entire thesis is the length of the cycle. I think the length of this cycle is 5 years. I changed my view. I thought it was going to be 4 years, but my forward-looking indicators kept pushing out. And I'm like, why is this happening? And then I realized the debt. And so 5 years is my time horizon. Everything else is just fucking noise. Ooh. And people rent conviction. Oh, Ravikant said it. And so-and-so said it, therefore we should buy it. Look, it's going up. So you build this reflexive loop. But the reality is people are just rotating money from something else that they're selling to try and find the thing. It needs to have proper long-term traction. So my view on this is, and I keep saying it, is we're a $3.5 trillion asset class today. Just take the trend rate of growth of the market cap in a log regression channel, and you get to 100 trillion in 10 years. And that's even assuming some slowing. So it doesn't go to 2 standard deviations overbought. Just some slowing of the trend, you get to 100 trillion. So we're only 3% of the way there. Then let's go back to, okay, Bitcoin dominance will fall over time versus smart contract dominance, which will rise because smart contracts have more use cases. That's not a diss against Bitcoin. It's just the applications layer is so much larger than the collateral layer, which is called Bitcoin, the collateral layer of the economic system. If you think of the collateral layer of the economic system, it's US treasuries. Then you look at the entire leverage of everything built on top of it, it's much bigger. So it's the same with this. So that layer over time will outperform. And so just making sure that you have enough of that exposure to capture this 3 trillion to 100 trillion, because it's not all going to be Bitcoin. That's actually the hard part. It's actually a little bit difficult to do because just buying ETH doesn't necessarily do it. But yeah, so the trade is still there. Yeah. Right? There's still a 30x in the entire market cap of the space, a 33x. That's monstrous. So what does it mean for some of the winning tokens? Not 1,000x's all over the place. But it's hard.
If you are watching the daily candles, you have already lost the game. The market is designed to separate you from your position through anxiety and noise. It whispers that the cycle is over, that the opportunity has passed. But the seasoned macro observer sees something else entirely. A coiled spring held down by a temporary vacuum of liquidity. The answer to navigating this volatility is the one answer most investors are psychologically incapable of accepting. Hold the right assets and do absolutely nothing. Raoul Pal calls this the "don't fuck this up" framework. It is a strategy built not on hope, but on the inevitability of the debt cycle. According to him, most participants are unrealistic. They want to multiply their money 20 times in a single month. When this fails, they panic. They do not realize that the dip of late 2025, driven by government liquidity withdrawals and shutdowns, was merely a structural reset. The liquidity required to drive the next leg up is not just a possibility, it is a systemic necessity. For years, the market worshipped the 4-year cycle as if it were a divine law handed down by Satoshi. But markets are driven by macroeconomics, not magic. But the cycle has shifted. In 2021 and 2022, the United States government extended the duration of its debt maturity to 5 years. This administrative change altered the rhythm of the global market. The massive liquidity injection that usually occurs in year 4 is now required in year 5, 2026. Investors frustrated by the sideways chop of 2025 are victims of a time horizon mismatch. They failed to see that the cycle length is 5 years. The delays and the noise are simply the friction of a system preparing for a massive refinancing event. This is where the mechanics of the financial system become the primary driver of price. The United States government has drained liquidity to dangerous lows, nuking risk assets in the process, but they have now run out of room to maneuver. While Wall Street obsesses over linearity and mean reversion, Silicon Valley understands the truth. We are in an exponential age. Crypto is currently a $3 trillion asset class. The long-term trend suggests it is moving toward 100 trillion over the next decade. And according to Raoul Pal, we are only 3% of the way through this journey. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Make sure to check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
People think.
Yeah, because again, Metcalfe's law is the number of users, total value transacted. So if right now we have to open a Coinbase account, we have to do this, and we have to do that, fine. It's restricted to whatever the number is. People say there's 650 million wallets right now. Okay, great. Put it on every mobile phone in a simple format, on every Apple wallet or whatever it is. You've suddenly got 5 billion people. They transact the same amount of value per person. Holy shit. I mean, it's really simple once you understand it. So yeah, the more access there is, the more people join it, the more value gets transacted on it.
Yeah. Just believe in something, guys. That's it.
No, but people believe we can't have nice things because they're too short term. So it's like, it's over. It's oh so over and we're so back. It's such a prevalent mindset that it happens almost on a daily basis. It's so over, we're so back, that people forget this stuff compounds over time because they don't have time horizon. You know, you and I have talked about this almost every time we've ever spoken, and yet people don't listen. But to show how hard it was, is Amazon came out. It's like, we can sell books on the new internet. And suddenly this stock started trading really expensive because it was the internet. And it was like, we can sell books. Maybe they can sell something else. Okay. The stock then falls 95%. It's like, it's so over. And then the market starts recovering and Amazon recovers. And Amazon's making no money at all. And the PE of Amazon keeps going up. And then from like 2014 to like 2018 or 17, it's trading at a PE of 850. Every hedge fund's trying to short it because they didn't see that it could go from a bookseller to being the largest online marketplace, of which it's not just about getting a revenue share of products sold, but it's also all of the businesses that can get built on top. Oh, that sounds like Metcalfe's law, doesn't it? And then all the ancillary services. Oh, we need to do something with our compute because we have all this compute. We need the cloud. They build AWS. And then, oh, let's create an entire logistics supply chain because they need Amazon warehouse. It's staggering how much value came out of that network. If you value the total network value of all of the business revenues, we only value Amazon really on the percentage of sales that they keep. But what is the total size of the Amazon economy? It's a monster. And no, it was not easy to see that or hold on to it from day one. That's the issue, is it was not easy. Microsoft, yeah, that was easy. It was everywhere.
But today we have this framework of tech and Silicon Valley with crypto. So it's less hard. It's still not easy. There's so much noise and there's so much volatility. And it's not just short term, like 1 to a week, 1 to a month, sometimes a year or two.
Yeah.
And it's painful because it's liquid, right?
Yeah, because the VCs didn't have that.
Mm.
They'd get annual mark to market, of which half time is just guessing, so they can lie about the volatility. When anybody knows who's run a startup, is we're so over, we're so back, is almost a daily occurrence when you're in a startup. You know, it's every day is an existential crisis, or you know what, we're all going to be gazillionaires, and it's never anywhere, somewhere in the middle of all of that.
I understand.
Wall Street thinks linear and mean reversion. That's their two things. And then they look at crypto, and every time there's a boom and a bust cycle, they think it's mean reverted. When we all know that if you put a nice log chart up, it's just actually a pretty smooth trend. And then you look at Amazon, Google, Tesla, all of these companies have all been the same. They're network adoption models. And so they're volatile in their early stages. And as they become more mature, they become less volatile. It's exactly the same. And Silicon Valley knows this intuitively. That's their entire business model.
And volatile could be chopping around for 5 years, like ETH has been doing, right?
Yeah.
But if you expand to maybe 20 or 25 years, you'll see that not only it's exponential, but that the meat of the growth happens later on.
So, good friend of mine, Mickey Malka, who's been on the podcast, Ribbit Capital, he was an investor, seed investor, I think, in Robinhood. Yeah, he's probably the best fintech investor of all time. So he got Robinhood, and it did nothing. They got no traction. Millennials, young people didn't want to trade stocks. Then the pandemic comes and it goes exponential. I mean, they did have a decent start, but then it kind of plateaued. Then it went like this. Then the GameStop thing came. I mean, Mickey had to bail them out because of this collateral call that I had, and had to stick in, you know, it was going to go existentially bust. You turn back, you barely see it in the chart now because it's gone up like a rocket ship, because it requires staying power and understanding that there are potential existential events, but if you survive them, you have Lindy effect, which means that the business becomes more valuable as a network over time. So you've got a lot of liquidity things happening all at the same time. In the middle of that, you've got the Clarity Act, whether it comes end of this year or by mid-Jan, it's coming. And that allows everybody to use crypto because it will have been defined on how to use it. So we've got an extraordinarily powerful year ahead of us. We've had to go through the hard part, which was this liquidity squeeze, but that will give us what we want going forwards. We then get the explosion of stable coins. This explosion of stable coins allow the government to issue more bonds, because we've got these new holders who could be anybody in any country now, are basically owning government bonds via stable coins. So the money is coming to roll the 10 trillion of debt. Meanwhile, the Chinese are printing money. Their balance sheet's increasing. The Japanese are doing massive fiscal stimulus. And so the game is on.
I forgot one thing before when we mentioned why podcasting is so amazing. You learn and you build conviction.
Yeah.
Literally.
Unless I'm totally fucking wrong.
Maybe. But I gather data from different people.
Yeah.
And I can build my own mind, right?
Yeah. So to go back to, you know, I always read what Hunter and Matt talk about. And they're like, Hunter's been around the crypto cycle for a long time. He's not saying it's the end of the cycle, nor's Matt. They're like, from what we see, we've got massive amounts of demand that's working through the pipe.
Yeah.
And so when you play with that and then you think of, okay, the liquidity analysis and all of the things, you're like, okay, probability is it's not over.
Just as Amazon traded sideways for years while building the infrastructure of the future economy, blockchain networks are compounding in value according to Metcalfe's law. The transition is happening now. The Clarity Act and regulatory shifts will open the floodgates for institutional utility. When digital assets move onto every mobile phone, the network effects become so large that current valuations will look like rounding errors. The volatility is the price of entry for this exponential growth. In the face of this inevitability, your greatest enemy is your own psychology. The goal is to construct a minimum regret portfolio. This means avoiding stupid risks and not looking back to realize you traded away a generational opportunity because you were impatient. Do not rent conviction from others. When the volatility hits, rented conviction disappears and you will sell at the...
No, it's not realistic, but it's the only answer people can find. Because you can say the other way, which is, oh, just get a second job or a third job. They're already doing 3 jobs. What is the answer? And I can't find one because we can't change the political system. We can't change the debasement of currency to pay for the debt. How do we give them a chance? Would you give them handouts? Possible. Or do you give them access to the casino? It's not the best answer. Because crypto at core, those people who are more desperate tend to go further down the casino route, as opposed to, and you mentioned this a lot in your X posts, is it's a slow game, but people want it to happen immediately. But really, if you just said, hey, in 10 years' time, I could probably 20x my money, I mean, that's la la land performance versus anything else. But people don't want to do it. They want 20x their money this month or this year. And then they break it down and they delude themselves that they only have the time of the cycle or this quarter or this trade. And it's like, and then people just get angry because it doesn't work. And it doesn't work. It's never worked. 1-2.
They don't want to.
And you see a lot of the anger is, and we've talked about this in the past, is time horizon mismatch. It's like you can tell them where it's going. This adoption of technology is not stopping. And it's at 3 and a bit trillion today. It's going to 100 trillion. So we're 3% of the journey there. And I'm saying it's probably going to take 10 years. That's a huge trade. And everyone's like, but what about today? The market went down. So the short term is more dominated by noise or shorter term factors. The long term is driven by the 2 key factors, network adoption and debasement of currency. So it's much more forecastable, probabilistically so. The short term is less so. So of course, the short term deviates from the long term often, always does. And people don't want to believe that. So, right, everyone put their hopes and dreams into the M2 chart. I said it's not going to always work perfectly. Everyone reads that as Raoul says it's going to work perfectly and it's always going to match. So then it deviates. So then my job as a macro analyst is to figure out, why is it deviating? What's changed? And you see it deviating on lots of charts, from monetary measures to historical parallels. And it's like, okay, something here has happened that I don't quite understand. So I then do the work on it. And I figure out, okay, this was to do with the and we can talk about the details of it, the withdrawal of liquidity as the Treasury built the general account. And so it's like, okay, it's understandable. We see what's going on. So you adjust your understanding of where you are in that long-term trend and what's going on. And then they had the government shutdown. People don't see that. They think it should all work perfectly. It never can do, because the short term always has a lot more noise to signal ratio and the long term has all of the signal to noise ratio
that you're talking about.
So I've seen this all before. I left the hedge fund industry back in 2004 because of this. So back in 2004, I was doing macro. Macro had been a higher volatile strategy, and it was longer term, because what macro means is you're basically trading around macroeconomics, economic forces. Now, there's one ISM data piece or one GDP day space a quarter, one ISM a month. You're using one data piece. So really you need a string of data pieces over a period of time to make a trend. So you're talking about a minimum trade of 6 months. Maybe at turning points, you might get a 3-month trade, but really it's 18 months to 3 years. That's what macro really is. And then what I realized is, as new investors came into the hedge fund investing space, they forced everybody into monthly mark to market. And then you were judged is how much did you go up or down that month? Not how are you doing over the year or how's that trade doing? And what you found is it didn't matter whether you bought something here and it had gone up there. If it had drawn down against you a bit that month and you're still well in profits, you actually closed the trade. And I'm like, nobody's going to make money like this. What it did was crush volatility and lowered everybody's returns. And the same is happening in crypto today. It got worse with macro because then the rise of the systems funds and the high frequency traders and everything else. So macro lost all of its edge from short-term trading. And I left to start Global Macro Investor to prove the point that longer-term time horizons win. And GMI is now easily the best performing research service in history. And that's with some terrible times within it as well. But it just proves that time horizon is the single best thing that you've got.
Highly underrated. Absolutely.
It is. But people are impatient and people want to do stuff. They want to trade around. And you don't need it. Find your adrenaline somewhere else.
This is a hard one for the ADHD generation.
Yeah. Yeah, because everything's a computer game, right?
The banana zone was delayed, not deleted. If the global plumbing unblocks, policy clarity, bank rails, stablecoins, and the $10 trillion roll, we won't get a quiet recovery. We'll get violent, asymmetric moves. The trade isn't moralizing, it's timing. Hold the right assets and do nothing, Pal says. Don't rent conviction. Tell us, are you positioned for a phased liquidity surge or still waiting for perfect confirmation? That's all we have for today. Please make sure to like, share, and subscribe, and we'll see you all in the next video.